All right, welcome to this explainer. Today, we're unpacking exactly how a modern IT service provider scales its financial growth strategy, and crucially, how they do it without bleeding cash. If you've ever looked at a rapidly growing company and thought, how on earth do they keep their finances from spiraling? Well, you're in the right place. We're going to look at the real-world example of Rasta Infotech to really get into the nuts and bolts of enterprise financial management. Let's kick things off with the ultimate business question that literally every growing enterprise faces. How does a company actually measure operational efficiency versus true profitability? Because here's the secret, they are absolutely not the same thing. A department can be incredibly efficient while generating zero revenue, while another might bring in millions but is just hemorrhaging costs. Understanding how to separate and measure these two forces, that is the absolute key to sustainable scaling. So here's our quick roadmap for today. We'll start with Rasta Infotech's growth strategy, then look at cost centers, which is playing defense, followed by profit centers, playing offense. After that, we'll do the ultimate accounting matchup, and finally wrap up with integrating for total transparency. Let's get into it. Section 1, Rasta Infotech's growth strategy. So, the foundational point here is that measuring both efficiency and profitability relies heavily on mastering the SAP Controlling module, or SAPCO. For a modern enterprise like Rasta Infotech, just glancing at a single bank account balance, that's basically useless for understanding business health. Scaling requires these two distinct pillars of SAP Controlling to track absolutely every single dollar entering or leaving the building. It's really the bedrock of their whole financial architecture. Moving on to Section 2, cost centers, or as we like to call it, playing defense. Okay, so by definition, a cost center is an organizational unit where costs are incurred, but, and this is super critical, they are not directly linked to revenue. Think of this as your corporate shield. These are the departments tracking expenses based on their specific functions, rather than the cash they bring in. They aren't selling products to clients, but let's be real, the business completely falls apart without them. Let's ground this in reality by looking at how Rasta Infotech actually operates. You've got your HR team spending money on recruitment seminars, onboarding, and training programs. Over in another wing, your IT support department is managing some incredibly costly software licenses and hardware upgrades. Neither of these departments is handing an invoice to a client for these tasks. I mean, as much as we'd love to bill clients for internal HR seminars, right? That money is purely outgoing, and it's tracked meticulously right here within the cost center framework. And this illustrates exactly how cost center accounting helps managers run a really tight ship. By isolating these outgoing expenses, leadership can run a strict budget versus actual analysis. Did IT spend what we projected they'd spend? And if not, why? It instantly highlights department inefficiencies and ultimately supports those broader cost reduction strategies. Without CCA, that kind of software license bloat would just get totally lost in the grand total of company expenses. All right, shifting gears to Section 3, profit centers, or playing offense. Now we see a major shift in accountability. A profit center is an organizational unit that's accountable for both revenues and expenses. So it's not just about keeping costs down anymore. It is all about the margin between what goes out and what comes in. This module is what measures the true profitability of specific divisions, products, or services. At Rasta Infotech, this is exactly where their SAP Consulting division really proves its worth. They use profit center accounting to measure the massive revenue coming in from enterprise client projects directly against the highly specialized salaries of the consultants actually doing the work. If a project brings in $1 million, but it takes $900,000 in consulting hours to pull off, well, the profit center instantly flags that margin is dangerously thin. Similarly, their digital marketing team uses this exact same accounting mechanism to prove their ROI. They're tracking the revenue generated from specific client campaigns directly against the ad spend required to launch them. It's essentially a closed-loop system of accountability. Every single dollar spent has to justify itself by, bringing a friend back home. So ultimately, profit center accounting lets leadership do three vital things. It provides granular profitability analysis by business unit. It helps compare performance across vastly different divisions, like, say, pitting SAP Consulting's margins directly against digital marketing's margins. And it really supports those big strategic decisions about exactly which services to scale aggressively. Which brings us to Section 4, the ultimate accounting matchup. There's a natural tension required to run a successful business. On one side of the ring, you have department managers who are laser-focused on expense tracking within their cost centers. On the other side, you've got these ambitious business unit leaders wanting to drive profitability within their profit centers. One group wants to save every single penny, and the other group wants to spend to grow. And the contrast here is practically night and day. Revenue is completely ignored in cost centers like HR and IT, but it's the absolute defining metric for profit centers like consulting and marketing. Yet the beauty of this is that both rely entirely on the exact same overarching software architecture, the SAP Controlling module. They're just utilizing it in entirely different but deeply complementary ways.
And finally, Section 5, Integrating for total transparency.
Here is where the real magic happens for the enterprise. Step 1, cost center accounting handles internal reporting to ensure operations are running at peak efficiency with zero wasted cash. Step 2, that feeds into profit center accounting, which integrates seamlessly with broader financial reporting for crystal clear division balance sheets. And Step 3, run side by side, they create total end-to-end transparency across the entire financial ecosystem. Ultimately, this integrated approach is exactly how Rasta Infotech succeeds. By combining these two pillars, management is completely empowered to make data-driven decisions that perfectly balance strict cost control with explosive growth. Honestly, you just cannot have one without the other and expect to survive in today's ultra-competitive IT landscape. As we wrap up this explainer today, I want to leave you with something to think about regarding your own role in your organization. Are your daily decisions driving just cost control, or are they driving true data-driven growth? Understanding whether you operate in a cost center or a profit center really is that crucial first step to maximizing your impact. Thanks so much for joining me to explore the mechanics of enterprise financial strategy and keep asking the right questions.